What's going on, you guys, and welcome back to the channel. Today we're doing a portfolio review on my own portfolio. I wouldn't say a portfolio review. This is more of an update. I think it's been a few months since I did the last one. I just want to share with you guys how things are looking. There's some slight changes. In general, I'd say the strategy is still very status quo, but certainly some allocations have been changed. Actually, a couple new additions, which I'll tease for you guys right now. I believe Lockheed Martin was in there the last time we chatted. So my first individual stock to complement my ETFs, I've actually added 2 additional positions since in a small cap stock, which is an exciting one we can chat about, and then also getting some exposure into Bitcoin. So that's obviously a very big addition, which I wanted to spend some time chatting about today, excuse me. But yeah, would love to know what you guys think of how the portfolio is looking. Any suggestions, any changes from your set of eyes? What do you guys think? Do you like it? Do you dislike it? In general, though, you still see the vast majority, over 90% of the portfolio is sitting in these passive ETFs, right? The passive strategy that I started doing essentially a year ago now. It probably was close to a year ago, actually. And I guess given the 1 year update, it has been absolutely perfect for my life and the amount of attention, if you will, that I care to put towards my portfolio. I did mention last time in a previous video, however, was that I did almost find them somewhat boring, almost like a little bit too passive, and I needed to start including a few of the stocks that at least allow me to have a little bit of fun and joy when I look at my portfolio. And that's why you'll see I do slowly introduce a couple holdings into the portfolio. Keep in mind, these are very, very small positions. So Lockheed Martin sitting at 2% of the portfolio, and then this smaller cap company Kits makes up 1%. So I believe this was about $1,000 as of the time of making the purchase. I bought about 100 shares. I forget what the exact number is. I'm sure if we go maybe to this tab, we could see. I think these are in US dollars. So actually, what I'm used to seeing is closer to 150,000. So yeah, the currency. Well, there you go. This is the one that I was referring to right here. So in Canadian dollars, which is what I typically would look at, the Kits position was about $1,300. So relative to the portfolio, especially for a more of a speculative stock, this is right in that range of where I feel comfortable having some fun, having more of a passion flyer stock, while also not, jeopardizing or risking my portfolio returns, especially for a company like this, which I have far less confidence in. Then you take a look at Lockheed Martin. Wow, I struggled to get that sentence out. You look at Lockheed Martin, a more decently fair position, I would say, for an individual stock. This one comes in at about $3,000. But yeah, why don't I not jump the gun? Let's go back one by one. Let's just use this page so you guys can see some numbers. VOO we don't need to cover. You guys know that this is the S&P 500 at this point. This makes up about half of my portfolio. You see 51%, about $77,000, up about 8% all time since purchasing this. Again, for those curious, when I did switch over brokerages, we essentially started blank slate. So a lot of these returns are probably going on about a year's worth of data, maybe 8 months, 9 months, I forget exactly. But the S&P 500, this is of course my core staple position. And before you guys ask, VOO versus VFV, we've covered this. Adrian, Canadian T-shirt, has done many videos if you really want to get to the bottom of this. I actually have a TikTok here, which I filmed relatively recently. If you guys want to go follow me on TikTok, let me see if I can track down where it is. It explains the video. It explains the VFV versus VOO situation fully, where you're talking about what accounts you're holding it in, what currency considerations you have to consider, like whether that's the hedged versus non-hedged, currency conversions. The video is right here. So by VFV or by VOO is the one that I'm referring to that you guys can go dig up and take a look at over on my TikTok page. But to get back into it, the second largest position for me, aside from the S&P 500, which is the 500 largest companies in America, pretty straightforward, is I have about 30% of the portfolio allocated to ZEQT. Now, ZEQT, you guys should know by now, is the BMO All Equity ETF. This is essentially an ETF that owns other ETFs. You'll see here, there's a total of 6 holdings. And if I zoom in here for you guys, you might be able to get a better sense of the fund. It owns the S&P 500, which again, I already own. So keep in mind, some may argue there's overlap here, double dipping, if you will. This is a very conscious action or decision that I've made being that I want to have more S&P 500 exposure. I have no issue double dipping here. But the benefit to a fund like this being an all-in-one fund or a fund of other funds is that I also have exposure to essentially 5 other areas of the market. I have exposure to Canada. I have exposure to the emerging markets. I have exposure to the international markets, emerging markets, excuse me. And then I even have a bit of small and mid cap exposure. Pretty negligible, I'd say, just 3% to like 3 to 4% combined. But in general, this is a fund that's getting me global exposure without me having to go out and manage 6 individual funds. So realistically, a question that someone may ask is like, when you use an all-in-one ETF like this, you are paying a higher fee. The fee here on this one's 20 basis points, management expense ratio. I could optimize and cut down on fees if I wanted to by not buying a ZQT, by not buying an XEQT or an FEQT, which are all the different funds companies spin on this product. I could go out and buy those ETFs individually, and really there's benefit to that, I would say, if you want to be a little more active. A, you're cutting down on fees because you're not buying the bundled product. And B, you also have more control. So you also have more control to say, listen, if I don't like these weightings, which are essentially predetermined for you, 45% US, 25% Canadian, 15, 17% international, et cetera, well, by you going out and buying those individually in your portfolio, you can flex and customize and choose whether you want to overweight a certain market, underweight a certain market, et cetera, et cetera. I'm happy just taking the package deal because I think the allocations are, for the most part, relatively fair. And also, when I combine that with my other holdings, it's right where I want it to be. So, for example, ZEQT, in my opinion, with 26% weighting to Canada, if I only held ZEQT, for my personal preference, I think that weighting's a little bit higher than I would like. Now, I know a lot of Canadians prefer the higher Canadian exposure, so very fair, to each their own. But for me personally, 26 is a little bit high. But when it's 26% of 30% of my portfolio, if you get where I'm getting at, that's right in the range where I'd want my Canadian market exposure to be. Hence why I'm happy holding these funds in conjunction, even though there is the overlap. But I hope that I'm walking you through essentially the logic, like the thinking that goes on behind my head as to why I hold these two funds in tandem, versus I know a big mistake that a lot of investors will do is, they'll buy the funds. They don't necessarily know where the exposure is or where the underlying holdings are and what the actual true weighting is within the portfolio. Just keep in mind, you guys, I've been very cautious of that and very thoughtful of that as to the weightings that I've decided. Now, the biggest one, which again is the controversial one, well, this is a couple controversial ones, maybe even 3 controversial ones within the portfolio now. Again, to each their own. This is just my portfolio, you guys, that I'm sharing with you. I don't encourage you guys to copy what I'm doing or do what I'm doing because I'm doing it. Yeah, everyone picks their own investments for what works for them and what they're comfortable with and what they want to invest in. The one that I'm personally comfortable investing in is ticker MCHI, which is now about 12.6% of my total portfolio here. And this is a fund that invests in China. And I actually believe there's still room for this fund to recover. I think the Chinese market is still in a depressed state. For those that recall, I mean, when I was owning individual stocks like Tencent and Alibaba, we essentially rid these all the way down. When I switched to ETFs, a part of me did miss these holdings, and I just felt I needed to get my revenge, if you will, which I half joke about that. I don't think that's the right way to ever approach the market in terms of I need to just break even or whatever the case is. I am just overly optimistic compared to a lot of people on the future of the Chinese market. And particularly when you look at the breakdown of this fund, you see about 17% is exposed to Tencent, which is, as you guys know, one of my favorite companies out there. Alibaba down at 10%, even companies like Xiaomi, which are these massive companies, which here in the Western world we won't know about. But these companies are, I don't know if Apple is the best comp, but these guys are making phones and all sorts of technology stuff, cars, really, really incredible companies and growing incredibly fast and incredibly well. This is a stock that's actually been trending very well into over the past little while. This is looking here at the Hong Kong market, I believe it is. But case in point being is that by owning an ETF like this, I'm not just banking solely on the couple stocks that I want exposure to. I am getting potentially some boosts from others, but also potentially some drawdowns for others. So it's more or less playing the field in that sense. And in my opinion, if my thesis on China plays out, I believe most, the fund like this should in general benefit. So at about 13% of my portfolio, this is about as high as I'd want it to go. And honestly, if it grows more because of growth, I mean, that's a huge plus. I can then look at possibly, what is that? I can then look at possibly trimming and adjusting, but I likely will not be adding to this fund anymore just for my own personal risk preferences. Moving along into the last 3 holdings, we do have some individual stocks, and I talked about at the top. I want to own, as time goes on, small positions in companies that I see opportunity in or pockets of value in that I want to hold, such as Lockheed Martin, which you guys know I've previously held, has been one of my favorite companies long term as a really core dividend stock. But I'm capping them at about 2.5% of the portfolio, just because I don't want to put too much weight on any of them. And Lockheed Martin is actually very similar to the place where I bought it at, so kind of near the support level. It's a stock that's yielding, it's not quite up at 3%, but Lockheed Martin is I'm not going to actually look it up right now for you guys, but Lockheed Martin is looking at their dividend, and actually the dividend to me is a really nice indicator for a stable company like this. It doesn't always apply, but for a stable company, when the dividend yield increases and we see that creeping up corresponding to a share price going down, that's one of the flags to me, that one of the initial flags, that kind of draws me in. Like, for example, when I see Lockheed Martin, which is a company I've been monitoring for years and years and years and years, there's only certain periods of time where the dividend yield does creep up to the higher edges of their band. That's one of the, when I see that happening, that's one of the things that makes me look into it a little bit further. Now, Lockheed Martin, of course, as part of my research and looking further, they have been, I would say, performing well. Not like knock it out of the park, but just stable, steady. It's kind of a toss-up as to the political influence and ties as to how favorable that will be over the short or long term, shorter term in particular. But I do think this is a company longer term that, despite losing certain key contracts, which is some of the news you may have heard over the past little while, it's one that I intend on continuing to hold. The largest defense player in the States, believe in the world actually, but certainly in the States. They do a lot more than just their fighter jets, albeit as a very key part of their business, don't get me wrong. But this is a company that just is one of those kind of forever holds, in my opinion, and one that, I've forever held previously in the past. And at these levels, again, pulling in the not quite 3% dividend, but close to, I think I'm a happy buyer at this point. The other small position that I have is a very small one called Kits, and you'll see this stock is trading for $13. They do have a relatively small market cap, so under 500 million. I think would certainly warrant itself in the smaller cap category. You'll see it's actually a very small company. So on Blossom, I mean, there's only 66 holders, relative to like a ETF like VFV, which has tens and tens of thousands of holders. This is a very, very small company, but they're actually a business that got on my radar maybe over the past couple months or so. I actually pulled them up here. What they are is a Canadian eyeglass or Eyecare company founded here locally. So Kits, I believe, stands for Kitsilano, which is where they're based, but also like maybe a glasses kit. They do glasses at a very affordable rate, but one of the big parts of their business too is prescription contact lenses. Honestly, this is one of those ones where I actually got my hands on a pair of these glasses, and you'll see the price of them. They're essentially going after the more affordable market. They do also have other stuff, like they're toying with designer and actually seeing good success in their designer collaboration style products. But in general, like the core of their business here being in just like affordable eyeglass or eye care for Canadians and Americans, but mainly Canadians. Once I got my hand on the product, I was like, there's actually something here. And I wear the sunglasses like pretty much every single day. And it's one of those ones where I made the comparison kind of to like Tesla, where you can hear about all this hype and you can say, oh, there's like all this and that. But then when you actually end up using the product, you see why there is such a desire for it and why there is such a fanfare and such an energy behind the company. And this is definitely one of the companies that I felt that type of energy. It's kind of an intangible and hard to maybe speak on. You can look at it from a numbers perspective, and hey, they're doing well. Again, newer company to the market. Excuse me, kids Eyecare stock. Newer company to the market, I would say. So however we see here, IPO'd back in 2021 and still obviously in the very high growth phase where they are making money and they are turning profit, but still early profitability in the big scheme of things. But that energy and the fact that this is a local company and a product that I actually genuinely like and support, I was like, you know what? I'm going to add this to my portfolio in a very small fashion, like what I would call almost a passion position. And hence why it only makes up less than 1% of my portfolio, but it's one that I think I'm very happy to support and very happy to own in the account. The last very exciting update for you guys, and very minor here, but it's Bitcoin. And I actually started adding crypto to my portfolio. And I've been asked for quite a long time, you know, why don't you own any crypto, Brandon? Or what's your take on crypto? And for the longest time, it was that I, didn't really follow it or didn't care too closely. And truthfully to you guys, that hasn't changed. Like I haven't gone, super down the rabbit holes into the crypto world. And it's not something that I even care or intend to do. But I do believe there's a couple reasons why having some crypto in your portfolio may be warranted. And I guess before I get into that, the way I decided to get my exposure into crypto was very simply by dollar cost averaging. I'm doing $100 a week. So that's the number that works for me. $100 a week. I'm just buying in on an automated schedule, essentially, where I don't really worry about how the price is going up, price is going down. I'm just going to slowly and steadily let it trickle up in my account. And I guess it's been going now for close to, 7 weeks, right? Because yeah, it's $100, $700, maybe a little bit less, maybe 6 weeks. And then some of it's from growth actually, because yeah, it is up 16% since purchasing. I mean, if you guys have been following it, crypto seems to be having a nice little short-term run here. I think the logic for me is that, for one, I do believe that crypto has now passed this inflection point, if you will, where it does, I do believe that it is here for the long haul. Now, amongst the crypto world, I'm not even going to get into the various different projects and coins and shit coins and all of that stuff because, again, I don't know enough about it. And also, I don't care enough about it to comment on which are going to be the next big up and coming ones. But more so, crypto as an asset class, I think is at the point where it has established itself as here for the long haul. And I think from a simple diversification standpoint in your portfolio, if you look at my net worth, I have my stock portfolio, my equities, my ETFs, my exposure to the stock market. I do as well have some real estate. I do believe that there's merit in having crypto. Again, I'm just playing it via Bitcoin, which is the way that I personally only care to do it. I'm not going to be playing with all the smaller ones. I do believe from simply a correlation standpoint, meaning having different assets that do different things and react differently at different times and areas, cycles in the market, I believe there's benefit there. The second point is that, crypto, as I'm sure we've all been following along, statistically has just continued to prove the naysayers wrong in terms of itself as an asset class and as itself as a investment, I should say. And it certainly is volatile and it certainly has its swings, but time and time again, every time you have a boom, you have this bust that falls and you have a boom that just seems to be going higher and higher and higher. I heard a very interesting take on crypto that it's one of those assets where the larger and larger it gets, the less risk it gets, right? If you think about the adoption that it needs, or if it were to replace, they say, gold, if you will, not that that's the way I envision it. I do envision it so much more of a store of value, as I'm sure most Bitcoin users do, or Bitcoin holders do, kind of a digital modern day store of value similar to gold. But the larger and larger it gets, the closer and closer it gets to serving its mission and its purpose. And again, over the years, it's something I followed very, loosely on the side, never talk about it much on the channel because, again, I don't feel overly qualified to speak on it. But I do believe that, essentially, all that to say, it's worth the risk for me of having a small portion of my portfolio potentially do poorly. And again, it's like a very small percentage of my portfolio now, but it will ultimately make up at this rate, slowly creep up to more and more. Maybe 1%, 2%, 3%, probably no more than 5% is where I'd personally want it to be at. But in my opinion, that's an allocation of my portfolio that I'm willing to risk on a asset like this or an asset class to give it the chance of doing what it intends to do. And you know what someone in the crypto world or what someone in the Bitcoin world would say is that, I mean, there's still a long ways to run if Bitcoin were to ultimately serve the purpose that it sets out for. So like I said, this is the big caveat in my portfolio that I don't want to ever like come across as I'm overly confident in it, like this is my expertise or anything of that sort, because that's certainly not the case. But I do think that as an investor, you don't have to be a quote unquote expert in a given space to make a decision within your portfolio that this is a calculated risk worth taking. And I guess that's really the messaging that I hope to display for you guys, you know, for my personal situation and what works for me with adding this and actually making the commitment to dollar cost average into this going forward. And of course, I'm still dollar cost averaging into my other positions as well. It's just that I'm also adding this into the mix. But hey, that is enough rambling on my end. And yeah, there's the updated look at the portfolio, you guys. I'm curious what you think on anything that I said, anything that you either agree with, disagree with. What's your opinion on how the portfolio has evolved? I'd say in general, it's still very much like true to kind of how I started building it, just with a couple of slight additions. And one thing I really am careful to do is not go overboard, because I know how easy it is to slowly start adding in all these stocks, and the next thing you know, it defeats the purpose of why I have this passive ETF strategy. But I think what I have right now is very, very suitable, and I think it's a portfolio that actually I'm super proud about and I actually very, very much like. But I'd love to hear what you guys think. Feel free to leave a comment down below. Share with me what you guys are up to with your portfolios, anything big, anything exciting. But yeah, there's a quick review video for you guys. Cheers.